Equity markets provided tepid returns in April. Is this a sign of things to come?
I think following a strong run as we've had in equity markets from October last year into middle of March, it's reasonably normal for markets to have a period of consolidation. We looked to take risk out of the Harmony portfolios as we went through the month of March, and we made the final trades in the first few days of April, in fact, bringing the portfolios down to neutral. We think that equity markets are likely to be quiet in the foreseeable future, but I don't think it's the start of a protracted negative period, if you like. What's interesting to have seen in the last week or so is, although equity markets have been negative, they've not been sharply negative. It's been a case of more drifting off, more consolidation, if you like, and I think that's reasonably healthy and a reasonably positive thing to do. It allows the market participants to pause, take stock, assess their positioning, and ensure in their own minds that they are comfortable with the valuations that they are working off, if you like. So it provides a period for the market to not get ahead of itself, and so yeah, we're reasonably confident that it's not the start of a protracted bear market.
Are the portfolios set up for a bear market now then?
I wouldn't say that. As I suggested, we are cautious on the equity markets, and as a result, we've taken a bit of profit, but we're now neutral, which is suggestive of the fact that we are broadly indifferent with respect to equity market valuations. We are still taking risk in the portfolio, if you like. We are positioned for slow but positive growth globally, and so it's not really positioned for a bear market. Where we are taking risk, it's still a risk on security, if you like. It's the likes of high yield, where we're overweight, convertible debt, where we're overweight, and also we're using strategic bond managers who are able to adjust their duration quite aggressively, their sensitivity to the bond market, if you like, in order to provide returns over benchmark.
What valuation opportunities are the Harmony portfolios presently positioned to exploit?
Well, as I mentioned, we have taken our equity weight down in the Harmony portfolios to broadly neutral on the basis that we think the valuations are more or less fair value in the global equity markets, generally speaking. We are able to add to that position if we see, bouts of market weakness, but generally speaking, we're comfortable being neutral in equities presently. Where we are underweight on the basis that we think there's not a valuation opportunity is very much the government bond market, particularly the core of the global government bond market, by which I mean the US, the UK, Germany and Japan. We're reasonably underweight those markets now, and we are using that cash generated from that underweight to invest in markets where we believe there are better valuation opportunities, such as high yield, investment grade credit, and the convertible bond market. Finally, the other position we're slightly overweight is cash, and that's largely to give us some dry powder which we can then put back into the market, as I mentioned, if we get these larger bouts of equity weakness.
What were the key performance drivers in April?
Well, the best performing asset class in April really was sovereign paper, particularly in the higher quality sovereign paper markets. We're underweight those markets, and as a result, from both an absolute and a relative perspective, the portfolio suffered slightly in April. It's important to bear in mind, though, the magnitude of the moves in the government bond market now. They're relatively small on the basis that the level of interest available on these securities is at such a low level that they're almost hitting a floor, and so although we didn't do too well by being underweight those markets, the differential that caused in the portfolio was only sort of a moderate impact, really. Neutral in the equity markets, so that largely speaking would have neutralised us versus the benchmark's performance, but it won't have impacted either way materially. Overweight high yield was actually a positive contributor from absolute return perspective. They produced positive returns over the month, but being overweight convertible debt impacted slightly. Their sensitivity to the equity market was reasonably high in April. Their delta, as it's known, impacted their returns, and they produced